All right, we will continue our discussion with general banking law. We left off with the nature of bank funds and bank deposits, right? So last meeting we've already discussed the policy of the law as well as the definition of banking and the classification of banks in the Philippines as expressly provided or under the red letter of the law, the General Banking Law of 2000. Now let's continue our discussion with the types of deposit accounts with banks in the Philippines. There are three types of deposit accounts. One would be the most popular and the most common one, which is the savings account. Second will be the current account, and third will be the time deposit or time accounts. Now, deposit accounts may further be classified as individual accounts, meaning accounts under the name of a single individual or a single person, or a joint account, which is an account of two or more individuals, and they are called co-depositors. For a joint account, there are two different versions. A joint account, which is an AND account, this is a particular joint account where, in order to withdraw the money from the bank, it requires now the signature of both co-depositors. Meaning, since it is provided that it is an AND account, one signature is not allowed for an amount to be withdrawn from that account. It has to be two signatures or more. All the signatures of the co-depositors must be present in an AND joint account. But in an AND or account, it means that either one of the co-depositors may deposit and withdraw money from the account even without the knowledge and consent and signature of the other. Because remember, the prima facie evidence of consent with respect to banking transactions would be the signature of the depositor. Without that signature, it will be assumed that that depositor does not have any consent as to that particular transaction. In an AND account, obviously, absence of that particular signature, it means that the co-depositor does not give consent or did not give consent to that particular transaction. And since the requirement is that all of the signatures of the depositors must be present in order to deposit or withdraw money from that account, that particular transaction will not push through. For an AND or account, since it is either, it means one signature of the co-depositors may do so, then the signatures of the other co-depositors may no longer be required. Now, in the case of VTOG versus Court of Appeals, which was decided in March 29, 1990, the Supreme Court elucidated that joint accounts may be subject of a survivorship agreement, whereby the co-depositors agree to permit either or them to withdraw the whole deposit during their lifetime and transferring the balance to the survivor upon the death of one of them. It poses kasi a complication class if this is a joint account where the signature of both co-depositors were required for withdrawal. So what if, class, during the time one of the co-depositors died? All right? So the death of one of the co-depositor would make it impossible now to provide the signature required in order to withdraw the money from the bank. However, the banking institutions provided, or say, legal experts or legal minds working for the banking industry provided for a solution for this. That in case of death of one of the co-depositors, in order to fast track now the transfer of the money from this joint account or to withdraw this money from the joint account, is to create a survivorship agreement between the co-depositors that should one of the co-depositors will die, the surviving co-depositor may withdraw now the money entirety from this joint account and transfer it to his own bank account. And this was questioned later on if this is valid. And the Supreme Court reinforced the validity of this survivorship agreement, considering that an agreement is still a binding contract between the parties. So one of the co-depositors or all of the co-depositors agreed to this particular arrangement. And obviously, this is practical considering that a death of a depositor, especially for a big amount of money, would still need clearance from the BIR before they're being allowed to withdraw, to be withdrawn from their account. And obtaining a clearance from the bank, from the BIR, is quite a lengthy process. And this is cash in a bank that we're talking about, bank account. So what will happen throughout this period that the clearance is not yet issued, right? This cannot be used by the co-depositor. So in order to make it practical and more pragmatic, survivorship agreements were also prepared and entered into by co-depositors, right? These are being entered into in order that should death happen to one of them, there is a quick and easy way for this amount of money in the joint account to be transferred to the survivor's own bank account, right? Now, what about anonymous accounts, or those accounts that not um named, or not registered, or not recorded under a specific name, or those what we call fictitious names? The Republic Act 9160, as amended by Republic Act 9194, and reinforced by the issuance of the Bangko Sentral ng Pilipinas of Circular number 251 on July 21, 2000, basically the same year that this particular law was enacted, expressly prohibited now anonymous accounts or those bank accounts under fictitious names, except of course in circumstances including when the numbered accounts is allowed in the banking industry. And when is these numbered accounts are allowed, meaning the accounts are not named under the particular depositor or account holder, but are specifically named only by a combination of codes or numbers. This is allowed in foreign currency deposits. However, class banks and non-bank financial institutions should ensure that the client is still identified in one way or another, be it in an official or other identifying documents. Meaning, even if in a foreign currency deposit that account is under a number account, meaning it is recorded under a combination of numbers or digits or codes, there must be a separate document that will verify the ownership of these foreign currency deposit accounts, right? Now, as I've discussed in our previous lesson, in our previous video, in the case of Tang Tiong Tik versus American Apothecaries, which is a 1938 landmark case by the Supreme Court, this particular case established the long settled principle that all bank deposits are considered as loans. The bank can make use of this money deposited in the bank for its own investments, and the bank is not required to return the exact bills with the exact control number, okay, or what we call the security features of that particular bills deposited. What is required of the bank is that it returns the same amount of money with of course with interest to the depositor, not the exact bills, not the exact paper money that were deposited or the coins that were deposited with the bank. And therefore, the bank is allowed now to consume the money deposited with it, and therefore, the nature of the deposits made by the depositors with the bank is actually a loan and not a trust or not a comodatum. As I've discussed, the nature of the bank deposit is a contract of mutuum, which is a loan, rather than a comodatum or a trust deposit. Note that the amount is not being held in trust for the depositor, nor it is being kept for safekeeping. The intention is for the bank to use these deposits to lend this to borrowers, to businessmen, and to make higher yielding investments in order for the bank to earn income out of the difference between the investment income and the interest that the bank is paying to the depositors. Right? That has long been established, 1938 pa lang, that the bank deposits as contemplated here is a loan, by nature of loan. And that is pre-World War II pa ha, na landmark case ng Supreme Court. And therefore, from this nature of a bank deposit, we can already surmise that the banking institution, the bank, for example, is your creditor, and as depositor, the bank is your debtor, and as depositor, you are actually the creditor, right? Sa'yo may utang ang bank. Obviously, if you have a loan with the bank, you are the borrower, right? But with respect to the deposit itself, the bank is the borrower and you are the creditor. You are lending the bank for that particular amount that you've deposited, because the nature of such a deposit is a loan. All right. Now let's proceed to the stipulation on interest. All right. Stipulation and interest. This has been provided as well. The rules on stipulation of interest. This is very important, as you will also encounter this one in your business law on credit. Okay. Um, the old rule, which is a circular by the Central Bank 416, provided for 12% per annum as legal interest. Now, this particular rate of 12% per annum legal interest applies only to loans, forbearance of money, goods, and credits. If you'll say forbearance of money, goods, and credits, is that you are allowing someone to use the money, goods, and credits in deference to your own enjoyment, and therefore allowing another individual to bear the enjoyment or use of your money, goods, and credits. You are allowed to charge interest. It's not like they just return the principal, obviously, because you have deferred your own enjoyment. All right, because you've deferred your own enjoyment, you have to charge interest, and that's 12% legal interest. And judgment involving such loan or forbearance in the absence of express agreement as to such rate of interest. Meaning, if you have not provided for an interest as to that particular loan or forbearance of money, the legal interest of 12% shall apply. And second would be that interest accruing from unpaid interest, meaning you have interest charged and then that particular interest is not also paid, together with the principal, that principal and interest shall also earn an interest from the time that it was judicially demanded, meaning, say, you file a case before the court and that particular case was your in favor, and the court said that you, together with the principal, you have also earned an interest out of it, and the non-payment of such principal and interest from the date of the demand by the court until it was paid by the creditor, it has to earn another interest as well, which will be 12% per annum as well. Although that particular obligation may be silent as to that particular agreement, because the court will now have the right to set now the interest accruing from your unpaid interest. So this is the old rule, which is 12% per annum. This particular legal interest now class was changed by the issuance of circular number 799 by the Monetary Board, which was declared effective July 1, 2013, where the rate of interest now for loan or forbearance of any money, goods, or credits, and the rate now for judgment involving such loan or forbearance, in the absence of any express contract as to such rate of interest, shall be 6% per annum. Why is it that is mentioned in the absence of an express contract as to such rate of interest? Because if there is an agreement class of another interest rate, that will, general rule, that will be followed. That's why, if you notice, credit card companies will have monthly rates that are, say, for example, 3%. So 3% monthly, so you'll probably have an annual interest rate of, say, 36. So that is way beyond the 6% per annum, and that is still valid because there is an agreement with that. However, class, note that the particular ceiling on interest rates was removed in the Philippines, but kasi before, hindi talaga pwedeng lumampas ng legal interest rates. But now, the ceiling is removed, and therefore parties can enter into agreements with each other, stipulating now an interest which may be higher than the annual interest. However, note, class, that there was a Supreme Court ruling saying that the removal of the ceiling of interest does not grant a carte blanche authority to parties to stipulate now onerous and iniquitous interest rates, meaning if the particular interest rate is already burdensome and unfair now to the parties, the courts now may decide to, say, establish now the legal interest rather than the agreed interest rates of the parties. Now, this particular new rule class means that if the parties will fail to state in writing any interest payable or any interest stipulation in the transactions mentioned or an account of a court judgment involving a related money, the particular legal interest of 6% shall prevail. Right? However, the, take note, class, that what is failed to state in writing must be the rate, because the um, courts may set it as the legal interest rate, which is 6%. There was a mention of payment of interest. It just so happened that there was no mention of interest rate. And therefore, what will apply would be the legal interest. Question, what if there was no mention of payment of interest altogether? Walang mention ng interest. Yung una, sinabi ko, walang mention ng interest rate. But what if there was no mention of interest? What will happen? Can you still impose the 6%? No. Because there is a requirement that in order for a party to charge an interest on a particular loan, it has to be in writing. So absence now of any written agreement as to the charging of interest, a party, the creditor, cannot impose and cannot demand now an interest from that particular loan, because it has to be in a written agreement that we will be charging interest in this particular loan. What is being contemplated in the previous statement that 6% legal interest will prevail is that there is already a written agreement of an interest to be charged. It just so happened that there was no mention of the interest rate. Right? It is very important to have that distinction, kasi interest class must be in a written agreement. Otherwise, you are not allowed to charge interest. Okay? The borrower will just have to return the principal. And if this is a court case, for example, the principal will have to be paid from the date of the judgment now of the court until it is paid by the borrower. So if it's not paid by the borrower immediately, that particular judgment will now have to charge interest 6% from the judicial demand. But as to the original debt, and from the time that you filed the case, wala yang siyang interest. Kasi ang nangyari is wala talagang agreement ng interest. Kapag nag-demand lang ang court, say for example, you filed a case, nagsabi ng court, oh, sige, bayaran nyo ito, at hindi pa bayad from the date of the judicial demand, after it was paid, yan yung may interest. But prior to that one, since walang agreement ng interest, wala yan siyang interest. Right? But what if may agreement kayo ng interest pero hindi na charge, hindi na agree? So from the date of the debt instrument, meaning say for example, promissory note, up to the time na nag-file ka ng case sa court, that will be principal plus 6% interest. Then from the time ngayon na may judgment na, yung principal plus interest will be the total judgment amount. And then from the judgment date until it is paid by the parties, meron yun siyang additional 6% annual. Right? Yan yung difference kapag may agreement ng interest na hindi na charge, hindi na set ang interest rates, and yung wala talagang agreement ng interest altogether. Alright? Now let's proceed to the grant of loan and security requirements. This is particularly important for banks to comply in order for loans to be held valid. Kasi there are certain security features provided for banks not to be scrupulous, unscrupulous, meaning for banks not to be reckless in granting loans, that certain loans must comply with requirements as to certain ratio, as to certain percentage with respect to the totality of the bank's net worth, and to ensure that the bank is liquid enough to support its daily operations, and liquid enough to cover now its deposit liabilities with its depositors. Right? Now, in determining now the ability of the banks to grant loans, we will encounter several terms. The first term will be the net worth. As defined under Section 24, Paragraph 2, in the 24.2 of the General Banking Law, net worth is defined as the total of the unimpaired paid-in surplus, retained earnings, and undivided profit, net of the valuation reserves and other adjustments as may be required by the Bangko Sentral ng Pilipinas. So basically, if you have your additional paid-in capital, or the APIC, which is the unimpaired paid-in surplus, and retained earnings, and of course, your undivided profits, You total that one and deduct the valuation reserves, and you will have now the net worth. And net worth now will be the basis of so many compliance later on. Now, risk-based capital, on the other hand, is the minimum ratio that is prescribed by the monetary board, which is the net worth of the bank that the bank must bear to its total risk assets, which may include contingent accounts. The monetary board may require or suspend compliance with this particular ratio, the risk-based capital, whenever necessary for a maximum of 1 year. So the compliance now of the bank may be suspended by the monetary board, the compliance with the risk-based capital ratio, but this suspension should not exceed 1 year, meaning maximum of 12 months. And that such ratio shall be applied uniformly to banks of the same category. Now, what will happen if you have not complied with the risk-based capital ratio? The monetary board may limit or prohibit altogether the distribution of net profits by the banks. And the monetary board may also require that part or all of these net profits, say the annual net profits or what we say the net income, will be used now to increase the capital accounts of the bank until the minimum requirements has been met. So the Bangko Sentral and the monetary board is adamant that for before the stockholders or owners of the bank to enjoy the profits, the bank must first comply with the risk-based capital ratio, because the foremost the responsibility of the Bangko Sentral and the monetary board is really to protect the public interest. And before this select few, the owners of banks and investors, banks, shareholders, before their interests are before their interests, really, what the state is trying to do is to ensure first that the protection requirements, all right, that were placed by the regulatory body are complied before you actually receive your share of the net profits. Now, general rule, um, acquisition of major assets and making new investments may also be restricted should the bank fail to comply with the risk-based capital ratio as prescribed by the Bangko Sentral. Except, however, if this acquisition would include the purchase of evidence of indebtedness that are already guaranteed by the government. Meaning, if the bank will have to acquire now instruments, debt instruments, or evidence of indebtedness, meaning documents of indebtedness like bonds, for example, while the risk-based capital ratio was not complied, generally the bank should have been non restricted or prohibited from acquiring now this debt of this document of indebtedness, such as the bonds. However, albeit the fact that there is non-compliance, if this acquisition of indebtedness is actually guaranteed by the Republic of the Philippines, it's as if kasi that this particular indebtedness is risk-free because this is guaranteed by the state itself. And therefore, this is exempted from such restriction or prohibition. This is provided under Section 34 of the General Banking Law. All right? Now, note class that this particular ratio is actually a security feature to check now that the bank's net worth is still capable of meeting its risk assets. So meaning if the bank is exposed to certain risk, the bank will still continue to operate. The bank will not fold because its net worth is capable of weathering such risk, right? That's the purpose of this ratio of net worth over its total risk assets. Now, let's proceed to this single borrower's limit, okay? A single borrower's limit means that the total amount of loans, credit accommodations, and guarantees that the bank could grant should at no time exceed 25% of the total net worth of the bank. This is provided under Section 35.1 of the General Banking Law as amended by the Bangko Sentral ng Pilipinas Circular 779 Series of 2013. Right? So for example, ang total loans na pwedeng mag-grant ng bank class or any accommodations, or if the bank will guarantee certain loans or certain obligations, at no time that particular borrower, a single borrower, should comprise 25% of the bank's net worth. Okay? So hindi pwedeng i-expose ng bank ang kanyang sarili ng more than 25% with a single borrower. The idea there is if that single borrower, for example, if the single borrower comprised 50% of the bank's net worth, should that borrower will get busted, declare bankruptcy, or becomes illiquid and insolvent for that matter, the bank is highly exposed because it already comprised 50% of all of the bank's debt receivables, right? Or its collectibles from the loans that it is granted. So what is required by the general banking law is that for a single borrower, it has to be limited only to 25% of the total of the bank's net worth or lower, right? Because again, this is to impose under the red letter of the law the idea that banks should not place all its eggs in one basket. It's actually a forced requirement of the bank to diversify the loans or the borrowings the loans that the bank is granting to its borrowers. Okay, so but of course there are exceptions to this if there is a separate prescription by the monetary board for reasons of national interest. For example, if the government through its government owned and controlled corporation wanted to borrow from that particular bank to support now state obligations, or especially to comply with the obligation of the state in parents in its role as parents patri, meaning in performance of the state of its um, obligations as protector of the citizenry, then the monetary board may provide for this exemption that, say, for example, a GOCC wanted to borrow and that borrowing will amount to 30% of that particular bank's net worth, but the state guarantees that this particular loan, meaning the state is guaranteeing that this will be paid, the monetary board may prescribe for an exemption to this particular single borrower's limit. And second is the deposits of rural banks with government-owned or controlled corporations or institutions like Land Bank of the Philippines, Development Bank of the Philippines, and Philippine National Bank. Remember kasi pag deposits class, um, um, for example, kailangan ng pera ng local government units, ang rural banks pala, for example, wanted to borrow money to provide credit in the rural areas in the countryside, and these rural banks have deposits with, say, governmental institutions or the government banks like LBP, Development Bank of the Philippines, or DBP, and PNB, the Philippine National Bank. These rural banks may borrow from the national government's banks, and they may exceed 25% of the bank's total net worth. Right? And of course, another limitation is that the total amount of loans, credit accommodations, and guarantees prescribed in paragraph A may be increased by an additional 10% of the net worth of such bank, provided that additional liabilities are adequately secured by trust receipts, shipping documents, warehouse receipts, and other similar documents which must be fully covered by an insurance. That's provided under section 35.2. Meaning, the monetary board may prescribe otherwise, but that particular increase will be additional of 10%, but should be supported by additional documents such as trust receipts, shipping documents, and warehouse receipts, and other documents that will establish proof that it is highly or it is properly or adequately insured. Another limitation would be loans and other credit accommodations secured by a real estate mortgage shall not exceed 75% of the appraised value of the real estate security plus 60% of the appraised value of the insured improvements. Okay? So for example, mag-loan ka from the bank, and then what will happen is in order to support your loan is you will enter into an agreement with the bank, which is a real estate mortgage. Say for example, the value of the particular real estate is 1 million. the security now that particular real estate can only cover up to 75% of that particular loan. Meaning, the real estate mortgage of 1 million should not secure a 1 million peso loan. It can only secure up to 750,000 of that particular real estate. Kasi ang maximum is 75% lang ng appraised value ng land. So for a 1 million land, it can only secure a loan for about 750,000 and below. And should there be improvements, meaning may bahay na tinayo sa land na yan, the appraised value of the improvements, which is say the house that was constructed there, would have a maximum of 60%. So all in all, the real estate mortgage that you will be executing cannot secure 100% of the total value of the loan. And that's why if you notice, for banking finance of say purchase of houses or real estate properties, you have to pay first a certain percentage before it will be allowed for bank financing, because the total amount of the property will not be covered, will not cover the entirety of the loan. It's only up to 75% of the value of the land and 60% of the appraised value of your improvements, which is the building or the structure that has been constructed on that particular land. All right? However, intangible properties such as patents, trademarks can also be used as security for loans, but the particular amount that they can secure shall not exceed 75% of the appraised value of these securities or intangible assets, right? Now, another limitation would be loans being contractual. The period of payment may be subject to stipulation by the parties. In case of amortization, the amortization schedule has no fixed period as it depends on the project to be financed, such that if it was capable of raising revenues, it should be at least once a year with a grace period of 3 years if the project to be financed is not that profitable, which could be deferred up to 5 years if the project was not capable of raising revenues, right? Now, there is also a limitation on grants of loans to what we call the DOS3 accounts. DOS3 meaning director, officers, stockholders with at least 1% of ownership over the bank, and related interests such as spouses of the directors, relatives of the directors, spouses, relatives within the first degree, whether by consanguinity or affinity, or partnership whereby the director, officer, or stockholder is a partner or corporation where the director, officer, stockholder owns at least 20%. So they are called related interest. So pag sinabi mong DOS3 class, you cannot grant loans to DOS3s. Meaning if you are at the bank, you cannot grant loans to your own director. You cannot grant loans to your officers or stockholders. Now, what are not included in this exclusion? Meaning, is this an absolute prohibition or restriction with respect to DOS3 accounts? Well, it's not really absolute. The bank can still grant loans to the DOSRIs, the DOSRI, if these are non-risk loans, such as loans secured by obligations by the Bangko Sentral ng Pilipinas or the Philippine government, loans that are fully guaranteed by the government, loans that are covered by assignment of deposits that are to be maintained in a leading bank and held in the Philippines. If these are loans, credit accommodations and acceptances under letters of credit to the extent covered by the margin deposits, and other loans or credit accommodations which the monetary board may specify as non-risk items. So for DOSRIs, they are only allowed to be granted loans by the bank to which these DOSRIs are related or affiliated if these are what we call non-risk loans. All right? Which are enumerated under this particular slide deck. Now, let's proceed to joint and solidarity signature practice, or what we call the JSS practice. It is a common banking practice requiring as an additional security for a loan granted to a corporation the joint and solidarity signature of a major stockholder or corporate officer of the borrowing corporation. And this is upheld by Security Bank versus Cuenca in an October 3, 2000 ruling of the Supreme Court. So in order for the bank to grant loans to corporations, there must be an accompaniment of a signature under that loan agreement with the corporation, with the corporation's major stockholder or a significant corporate officer. Okay? So for restrictions to DOS 3 class, these restrictions imposed by law um, on DOS 3 transactions is that no director, officer, or any bank shall directly or indirectly for himself or as a representative or agent of others to borrow from the bank to which they are related, to become a guarantor, endorser, or surety for loans from such banks to others, or in any manner be an obligor, meaning a debtor, or incur any contractual liability to the bank. An exemption, of course, is there is a written approval of the majority of all members of the board of directors of the bank, excluding the very director himself. The DOS, the D in the DOS3 was not included in the approval by the majority of all members of the board of directors. So note na pwede yan sila magkaroon ng loan sa banks if nag-agree ang members ng board of directors. But generally, those risk class are not allowed to borrow from the bank to which they are affiliated or related to, and also they cannot guarantee loans with that particular bank or in any manner whatsoever be an obligor or debtor or to incur any contractual liability with that specific bank. Does it mean that if you're a DOS3 of BDO, you can no longer borrow money from BPI? No, because in the perspective of BPI, you're not a DOS3, right? You have to be a DOS3 of that particular bank to for you to be restricted with respect to contractual obligations or to incur any borrowings or debts from that particular bank, right? Now, what if you are a DOS3 account? What are the requirements that must be complied? First is the procedural requirement is that if you would grant a loan with a particular DOS3, it must be approved by the majority of all directors, except of course the director involved or the director concerned. The approval is not necessary by the central bank. However, you have to notify the central bank for this particular loan or prior to the entering of this particular transaction or loan obligation. Then the loan must be entered in the books of the corporation. It has to be recorded, because if this is not recorded, then this is highly suspicious, because if not recorded, then therefore this is more of an accommodation for the benefit of the DOS3 rather than a legitimate loan obligation. Second would be the substantive requirement is that the particular loan granted to the DOS3s must not exceed the paid-in contribution as well as the unencumbered deposits. And of course, the loans to be granted to the DOS3s must not exceed 15% of the total portfolio or 100% of the net worth, whichever is lower. Now, in the case of Go versus Bangko Sentral ng Pilipinas, a 2009 case, the Supreme Court held that the requirements for the granting of loans or the obligations with DOS3 accounts must first obtain an approval requirement, which means that the DOS3 transaction must first be approved by at least majority of the directors, excluding the director concerned. A reportorial requirement which that the transaction must be reported to the Bangko Sentral ng Pilipinas and must be recorded in the books of the bank. And the ceiling requirement, which means that the amount shall not exceed the book valued of the paid-in contribution and the amount of the unencumbered deposits of the bank. The three different offenses will be committed by those who fail to observe the particular approval. Okay? Now, effect of non-compliance with the foregoing requirements. Now, for violation of DOS3 is a crime and carries with it a penal sanction. Now, for violation of this DOS3 account does not make the transaction void, meaning it does not render that particular loan transaction with the DOS3 as void. It's still valid. However, the officers or directors of the bank that have violated the requirements, the procedural, substantive, and the sealing requirements for the DOS3 accounts, they will be held criminally liable as elucidated by the Supreme Court in the case of Republic versus Sandigan Bayan in a 2011 case. Also, in the case of Soriano versus People of the Philippines, a loan transaction within the ambit of the DOS3 regulation could also be subject of estafa or swindling under Article 315, paragraph 1B of the revised penal code. Okay? Now, for transactions covered by the DOS regulation, they are covered are loan and credit accommodation. Now, if this particular transaction with the bank is not a loan, the ceiling will not apply. So, for example, if the DOS 3 enters into transaction with the bank with respect to a lease agreement, meaning nagparenta pala ang bank with that particular DOS 3, the ceiling will not apply because this is not a loan nor a credit accommodation. However, for any transaction with a DOSRI that is not loan and credit accommodation, the procedural and the procedural requirement, meaning the approval by majority of the board of directors, shall still apply. Meaning, yeah, hindi nga siya loan accommodation, dili nga siya loan accommodation, dili siya loan itself. But the particular transaction entered into the bank is with a DOS3, meaning with a director, officer, shareholder, or related interest. Say a lease agreement. Will this have to be exempt with the entirety of the requirements? No. It still requires now the reportorial requirement, which is to report it to the BSP, to record it in the books of accounts of the banks, as well as the approval of the majority of all board of directors except the board of director concerned. The director concerned. However, since this is not a loan or a credit accommodation, the ceiling requirement will not apply. Now, the important thing, class, is if there are transactions that are not loan or credit accommodation with a DOSRI, it has to be under an arm's length. It must be considered as an arm's length transaction. That any dealings of the bank with any of its DOSRI shall be of any terms that is not less favorable if this is done with third parties or other persons. It has to be arm's length, meaning at par with transactions with strangers or with individuals or third parties. Okay? So the bank may terminate the loan and demand immediate payment if the borrower used the funds for purposes other than agreed upon. In a case of Bangko de Oro versus Bayuga, in an October 17, 1979 case, the Supreme Court held that if the bank finds that the borrower has not employed the funds borrowed for the purpose agreed upon between the bank and the borrower, the bank may terminate the loan and demand immediate payment of that particular loan. So it is important that the application of the loan states the purpose for which the loan will be used and that the borrower will have to make good of that particular application. If the particular loan was applied for the purpose of expansion of the business or the construction of certain facilities, it has to be utilized for that particular purpose for which the bank approved. Otherwise, if it was used in another purpose or another endeavor, the bank may demand for the payment, the immediate payment of the loan, irrespective of the original terms or installment payments. All right? Okay. So that concludes our discussion on our second topic on general banking law.